Well, thanks, Dave, and thank everyone for being here. Want to give you some day trading ideas here. I trade the mini S&Ps and related stock-related index futures. And what I hope to do today is I'm going to give you what I consider to be the two most important day trading tools, indicators. Then I'm going to give you evidence as to why I believe in them the way I do. And then finally, I'm going to give you two systems, tradable systems, you'll actually be able to use as is. So we're going to be determining that the trend, determining the trend early is the key to back-tested systems. I want to give you a little background information on me first. For those of you that have seen this already, I apologize, but not everybody has. I want to give you some background on who I am and what my trading techniques are. Been a member of the Chicago Board of Trade for over 30 years. At the time that I got my membership, I had just started successfully trading mechanical systems that I had developed. And I was hoping to go to the floor and augment what I was doing with some pit expertise. That didn't turn out very well. I am a proactive trader. Everything is set up in execution. The pits are totally reactive. But it wasn't a total loss. Met a lot of interesting characters. Used some of them in the books that I later wrote. That came about shortly after I got my membership. I approached one of my favorite trading experts, Bruce Babcock. I said, what can I do to get some public recognition for my trading? He said, well, write a book. I said, well, that's not hard for me. I've been writing all my life. So I wrote Market Wrap, The Odyssey of Still Struggling Commodity Trader, and 3 books after that. This is the most recent full book you're seeing in front of you. In 2017, I wrote a follow-up almanac, and I'm currently working on the 2020 version of that now. So again, you can break my trading history into 2 distinct parts. My aggregate triumphs have come from strict mechanical systems, no judgment allowed, where I enter, where I exit, where I take profit, where I get my stops. All that is pre-mandated according to what I had seen in past data. And I don't think that I'm different than almost all traders, as a matter of fact. 90 to 90% of us lose money to the remaining minority. Since most people are neither systematic nor mechanical and trade according to whatever whim strikes their fancy at the moment, it just stands to reason you do not want to do what the majority of people are doing unless you're content being in that sizable loser pool. There's very deep psychological reasons for that, and I could talk about that for hours and hours and hours. The problem is we are not wired to trade money-making fashion, most of us. There's going to be the occasional, you read about the market wizard that just absolutely defied all the odds. The thing about the market wizard, though, is they discovered their talent almost instantaneously. If you've been trading for months and not getting anywhere, chances are you could use the mechanical approach. Why aren't we wired to trade effectively? And again, this goes to psychology 101. A lot of stuff they've demonstrated in labs. Where'd you go there? People are resistant to taking losses under the theory that they're going to come back. And if you've traded long enough, you have plenty of examples of that in your head. of something that you hung on to. It was harrowing and terrifying, but you stupidly hung on, and it eventually came back and rewarded you. Conversely, we all have it in the back of our heads, those profits that we couldn't hang on to, got away and became losses. So this is, again, the market trying to teach us how to trade wrong, acting like a malevolent opponent. It's not literally the case, but it's not bad to think of the market that way. It wants to follow you up. So Trading 101, as we all know, says that you maximize your profits, you let them run as much as you can, and you cut your losses short, 180 degrees of what our inclinations are. Now, another thing is people tend to impose order where there is none. I challenge you the next time you're looking at that textbook classic Head and Shoulders, top or bottom, and you go, yeah, it brackets the trade perfectly. You see it reverse and go the other direction. But be a hard-nosed analyst. Next time you see one of those pages, look in the middle of them, and almost certainly you're going to find something that could have been a Head and Shoulders that didn't reverse the move, but just continued in that direction. People tend to lose sight of the only real reason to trade. The only real reason to trade as a speculator is to make money. And that should be a no duh. But the thing about trading is it's different than most other aspects of the business world. There's no product. There's no chance to be altruistic. It's just dollars and cents changing hands. But people tend to do things like grudge trade. I have a friend that's broken many phones against the wall because the market owed him. I just never knew that. Trading is a proving ground, your spouse or your father, yourself, whatever. And then the most insidious thing of all can happen to you. Trading can be an addiction, just like betting on the horses or slot machines or anything else. The other reason that spontaneity doesn't tend to work for the vast majority of us is that the trades that we fear the most tend to pay off the most. I am a living example of that, both when I was disciplined and took trades that just scared the life out of me and wound up being the best trades of the last 3 to 6 months or something. And I've also been on the other side of it where the trade scared me enough to where I didn't take it, and I sat on the sidelines and watched a paper product that I was supposed to take just go to the moon. It's almost like voodoo. But if you analyze why that is a possibility, it's again down to if most people are really enthusiastic about something, where is the grist for the mill going to come from? Where is the reward going to come from if you're all on the same side looking for other people to reward you? It's not that hard to believe when you step back and think about it. Conversely, the biggest problems arise in trades in which people are the most comfortable, complacent, and confident. So why does mechanical trading work? Obviously, because it bypasses those pitfalls. Okay, if you've got a roadmap that says you have to buy here and you have to follow every trade, and you can't second guess which ones to take and which ones not to take, and you can't second guess when to increase your position size or anything else, well, you can sweat bullets on the sidelines, but as long as you intervene in what the system is doing, it's not going to be impacted. Stands to reason. The other thing that mechanical trading does for you is it imposes accountability and discipline, following rules and working toward goals. When I was on the floor, everybody just loved to tout their trades. They would say, get in soybeans, go long. This is going to be the the career-making trade is going to be just an incredible drought or whatever their thing was. And then when the trade didn't work out, they always had a reason for it. Well, I failed to notice that the bonds weren't in the S&Ps, and next time it'll be different. Well, next time there's always a different excuse, and the effect is like trying to punch your way out of a paper bag. Good decisions, or I should say, winning trades do not necessarily start over. Good decisions do not necessarily reward you. Bad decisions do not necessarily result in losses. Okay. Sometimes you can make dumb moves and make money, and vice versa. So, again, that's not doing much to move you forward as far as knowledge that you can carry forward into the future. But when you're trading mechanically, you have an absolute blueprint. If you sidestep it, you know exactly what was supposed to happen. You can't kid yourself. You can't be one of those floor traders coming up with a million different excuses. Problem is, that's harder work, of course, and that's why a lot of people don't want to be accountable. They just want to fly by the seat of their pants. All right, so we're going to talk about day trading in the S&Ps, Dow, Russell, Midcap, NASDAQ, and I think people tend to be attracted to day trading. I had very good years being an intraday trader where I would hold a trade overnight as many days as it was necessary before the signal reversed or got me out. But the whole time I was doing it, I appreciated what day trading would offer, namely no overnight risk for starters. That's, now that we have 24-hour trade, that's not as big a problem as it used to be, although we still have those harrowing 2-day weekends where you're long an S&P or something, and all of a sudden, something breaks out in the world and you're sweating the weekend. It's nicer to just start clean slate, fresh every day, and that certainly lessens trading stress. I used to hold a lot of positions, probably more than my account size said that I should have been. And let me tell you, there were some sleepless nights. Also, you have an ability to leverage more from smaller startup capital, and that could be a big disadvantage too, by the way. But whatever the margin is, they usually let you trade, I think it's 4 times, maybe 5 times the amount if you're just day trading and never holding overnight. So you have that advantage. All right, we are now at the meat of what I want to show you. Day trading assertions confirmed in back testing. There are 2 key things that I want to do when I'm day trading. First is I want to be in the direction that the close is relative to the daily open. Okay, we're talking the 8:30 a.m. Central Standard Time day session opening. That opening is a wonderful, wonderful demarcation line. If all you did to improve your trades was throw out every trade, and I'm talking whatever system you have, throw out every trade where you're trying to buy when you're underneath that daily open, throw out every trade where you're trying to short sell every day, every trade where you're over it, I can almost guarantee your bottom line would improve, maybe dramatically. Love that daily open, and I don't want to fight the direction that I am relative to it. Second, it is better to enter positions early rather than late in the day session. The early trades are always more, not always, nothing's always, tend to be more reliable than the later ones. I'm going to give you some proofs here. We're starting with the first contention that you want to be on the You want to tend to be a buyer when you're above the daily open. You want to tend to be a short seller when you're below it. What this is an optimization study of 10-minute bars from 8:40, the top line, 8:50, 9 o'clock, 9:10, etc., up through 2:30, okay, in that order. And what this is saying is, if we're on the top line, we're saying every day at 8:40, we're going to go long if the close is above the daily open. We're going to go short if it's below it. This line says at 8:50, we're doing that. We're always doing the same method. Each line gives you a different time you're doing it. And as you can see, you've got 3 losers out of this optimization field, and only one of them is significant. The other 2 are pretty close to break even. Now I'm going to go to one that's an anomaly right away, because I like to go in this order: S&P, Dow, NASDAQ, Russell, Midcap. This one kind of defies that axiom. There's some reasons for that. It's not important that I hit those reasons too hard, but some of the techniques I use in trading is I use the Dow as a fade indicator relative to the other markets. If the S&Ps are stronger than the Dow, both markets are up, but the S&P on a percentage basis is stronger than the Dow, the up move is more reliable than if it were weaker than the Dow, if it were lagging it. Okay, today you saw a market that was sharply lower, but on a percentage basis, the S&Ps were not as weak as the Dow was. And so by the end of the day, it was trading closer to the highs than the lows. So that may be one reason. You know, you're talking shorter basket, a smaller basket of stocks in the Dow, and they tend to be the bellwethers, the ones, you know, that are not as volatile. So it's possible that when people are panicking, it's like the Dow 30 stocks that are the last to get rattled. But all right, I probably went too far in that direction. Let's get back to, you know, how the tendency does work. This is the NASDAQ. We got a few losers here, but the majority is going with the momentum, going up when you're above the daily open, down when you're below it. Now, when we get to the Russell, there's not a loser in the batch. So that is phenomenal affirmation of the concept. And then when we get to the mid cap, it's almost as good. Didn't like too early on in the day time periods, but all the rest winners, some of them quite large. All right, now, second contention that you want to be in early rather than late, and in demonstrating something to you here, I hope I put to rest forever the argument that the markets are random, that the so-called random walk theory, that the markets can go anywhere, anytime, and there is no tendencies within them. Just with this simple exercise. I should be mentioning, I should have mentioned before that these studies went from the beginning of 2010 through first half of the year, June 30th. Okay, so you got roughly 10 years of data, and what we're going to wind up with is going to hardly be considered fluky, all right, considering the sheer volume of trades. Anyway, you would expect markets to open within the top or bottom 5% of what winds up in the day's range, 10% of the time, right? Market opens, it trades up through 3:15 in the afternoon, and you get a bar where you see the open and the high and the low and the close, right? So where that open wound up being, you would expect to see it in the bottom 5% of the range or the top 5% of the range 10% of the time. But here's the actual results. It's roughly 50% more often than what blind chance would suggest. Okay. Also, how often would you expect it to open in the top or bottom 10% of the time? 10% of the range, rather. 20% of the time, obviously. But here, 25, 27, 27, 26, 26. And for the 15%, you'd expect 30% of the time. And you get the high 30s. So how is that random? And it kind of tells you that, it's a given that markets are going to move, but you'd expect a portion of the move to happen early on. Stands to reason, right? So why would you not give yourself best opportunity to get the biggest potential move? The earlier your system or your methodology, whatever it is, will get you in, the better off you will be. Now, like the bellwether time frame, we were just looking at 10-minute intervals. Let's scale it back to 5 minutes. The first 5 minutes of the day, ending at 8:35 a.m. You should be a buyer at that time if you're above the daily opening price, and a seller if you're below it. Okay, just what we've been doing, but now we're doing it at 8:35. I'm going to show you this is an especially good time to be doing it. And as we were doing before, exit at the 3:15 Central Time session close. And now you're looking at some pretty interesting numbers, okay? Again, you can't really call this fluky. Over 10,000 total trades. I didn't put slippage commission in these average trades, but you could dock $10, $15 from each, and you still have a definitive bias. Net profits speak for themselves. They go from 42,000 to 108,000. Drawdowns. Keep in mind, that this is not a system per se that I'm giving you. It's just I'm trying to show you a tendency. This is the one thing that would be prohibitive. Most of us wouldn't want to suffer this much at the worst level in the equity. You take the net profit and divide it by the worst drawdown. You get what's known as the return on account, which is a percent that your account would have increased had you started with your worst drawdown amount. This is what I normally optimize for rather than just simple net profit, because it gives you your expectations in relative terms. So I'll put the first 3 5-minute periods on here so that you can compare and see that it's always going to turn out to be, you want to go with the very first one. It's the S&P, Dow, NASDAQ, Russell, mid-cap. Now, I think we've pretty much demonstrated that entering at 8:35 and holding through the day is a nice bias. But you don't have to wait that long. This is an optimization study showing that regardless of when you exit on this 8:35 trade, we're doing 10 minutes again, so this would be 8:40, 8:50, 9 o'clock, 9:10, blah, blah, up to 2:30. Regardless of when you exited on that trade, you still have a winning performance summary, which is also true in the Dow. Okay. The NASDAQ. How about this? We're not seeing one contrary result. So, remember when we were just looking at entering at any time of day and the Dow didn't conform to that? Well, even the Dow likes the 835 entry. All right, get your pens and papers ready. I'm going to give you a winning system here. 8:40. Okay, the second 5-minute bar. I was going to show you a TradeStation show study on that because I wanted you to guess what was unique about the 8:40 bar. Unfortunately, my power went out and I'm on a second computer that I didn't intend to go on. So I'll just tell you. What makes the second bar of the day unique is it's the first bar that can trade completely beyond the opening price. In other words, maybe you're above the opening price and the low is not even touching it. That's not possible, obviously, on the bar that had the opening price in it. So 8:40 I've always considered significant too. First bar that could be a total breakaway. Low completely above the daily open, high completely below the daily open. So here's how this system works. At the close of the second bar, 8:40 a.m. Central Time, buy if the entire 835 to 840 bar is above the day session opening price. The low does not touch the daily open. Sell short if the entire bar is that should say below. Shame on me. Sell short if the entire bar is below the opening price. Exit at 3:15 p.m. Central Time, day session only. Close. Okay, I did have this on this computer too. I am a little harried, folks. It was a little stressful to be racing to get onto this in time for my lecture. All's well that ends well, though. All right, so you see, this is the second bar right here, and it was entirely above the daily opening bar, the daily opening price, rather. Okay. On this side, your second bar was completely below it. So that's all there is to that. These are the results. Now, I said you can actually trade this. I didn't put stop losses in here. They will tend to decrease these results, but you can get winning results anyway, even using anywhere from like $200 to $500 stops. Now that return on account that I mentioned that I like to test for, 1,586% increase on an initial $3,175 investment. Not too shabby. 821, 832. So it's a system that tends to work better on the old bellwethers, Dow, Russell, not Russell, Dow, S&P, and NASDAQ. Not quite as good in the Russell and the mid cap. I'm going to give you a second system now because it's the holiday season and I'm feeling generous. I'm going to look back at that first 5-minute system. which told us just to simply buy at 8:35 if we're above the daily open price and sell if we're below it. But we're going to put a filter on there. Only take the trade if the opening was above the previous day's high. And at 8:35, if you're below the daily session open, only take the trade if the opening was below the previous day's low. So I'm putting this up here as sort of a reminder of what we had, which is doing the original 8:35 idea. Keep your eyes on the bouncing ball. Now, you're not going to be able to trade every day, and you're going to lose a bunch of trades, which means our statistical reliability isn't quite as good as it was, but still enough trades that it's valid. And it's certainly a consistent improvement across the board, particularly in the return on accounts, which jump up many multiples. About the same in the NASDAQ and the Russell. But several multiples in all the others. And the drawdowns are now extremely manageable. So, Merry Christmas. Your takeaways: best approach for the overwhelming majority of traders is to develop systems that are 100% mechanical. There are market characteristics that could be incorporated into such systems or used simply as indicators. Day session, 8:30 a.m. Central Time opening can be used as the ultimate demarcation line, be inclined to be long if you're above it and short if you're below it. As a general trading rule, the earlier you can establish a position, the better. First 5-minute move of the day is especially reliable, and you can do well using that concept with filters, stops, and other things that you should be looking at in your lab. Second 5-minute bar is also quite significant. So again, I'm working on the 2020 Almanac, keying off my Beating the Financial Futures book. Look for that.